Hi, I'm Josh Mahony, Chief Market Analyst at Scope Markets. Let's take a look at the week ahead for the week starting Monday, the 5th of February. Certainly coming off the back of a very busy week just gone where we saw the Bank of England, the Federal Reserve, and most of the big tech names coming out, and then ultimately ending the week with the US jobs report. We're seeing things calm down a little on the economic front. That's not necessarily a bad thing. Certainly everything that's gone before this does lay the foundations for what we could expect going forward. So let's look at some of the key events to be watching out for and then try and ascertain what markets might see some significant movements around that and see some potential layups. This is a sort of wider overview on some of the key events for the week. Certainly you can see that coming off the back of a week where we saw, big inflation data and jobs data, things are a little bit more quiet. You're probably going to be drawn towards some of the key events, such as the RBA's interest rate decision. We've got the jobs report coming out of New Zealand. Chinese inflation probably likely to remain in deflation, and ending the week with that Canadian jobs report, which sometimes gets separated from the US jobs report, which is the case this time around. But let's pick out three themes for the week and then go into how we could potentially see the market associated with that. Theme one is the US. Certainly, the big picture here is, are we going to see something that is going to threaten the economic picture in the US and therefore push the Federal Reserve into cutting rates sooner? It's highly unlikely. And if you look at some of the main events, I'd probably pick out the ISM Services PMI as the most notable of the lot, because the top two in terms of the main PMI numbers, they're just revisions. So the question mark is whether we're going to get a significant revision. Well, it's less likely than it is a significant change in terms of that services PMI number. Key figures will also come out in form of the export numbers from the trade balance and the initial jobless claims figures. But certainly, I don't necessarily think we're going to see any major warning signs from the jobs perspective. But this essentially gives us a good excuse to look into the US dollar. And let me just full screen this. One of the markets that I think is particularly interesting here is the US dollar against the Swiss franc. Now, we've seen the dollar coming off once again. Bear in mind, we came into the week thinking we could potentially see a big uptick if we see a pushback against that March rate cut. We have seen that pushback. We have seen markets repricing against that. But nonetheless, it almost feels like a bit of a buy the rumor, sell the fact move with the US dollar. We're seeing the US dollar coming off and equity markets looking relatively strong, helped significantly by what's happened in terms of tech stocks on Thursday. Nonetheless, the US dollar looks to be weakening. And so you're either going to pair it up with a risk asset, and therefore you're just trading on, is it going to be risk on? Is it going to be risk off? Which is one way of doing it. Or you pair it up with a fellow haven and you look for a trend. And certainly the US dollar against the Swiss franc is exactly that. You can see over the course of the past 6 months, we've seen this coming off quite heavily. And the recent rally took us into the 76.4 Fibonacci level, rolling over and following through on that move. The daily time frame shows us exactly that. So I'm expecting to see the potential for further downside here. If you're looking at this recent bearish trend, then for that to continue, we just need to see this remain below this most recent swing high of 86496. So this essentially points towards the potential for any near-term upside to be a potential retracement rather than a reversal, as long as we stay below the prior swing high, like I said on this occasion, 86496. So US dollar against the Swiss franc, that's the one I'm going to be watching over the course of the week. We've come off the back of 2 weeks of downside, and there's a good chance that we do continue that trend given the wider downward pattern that we've been seeing over recent months. Next, let's look back at the calendar and look at the second theme. That is the Australian economy, chiefly because of the fact that we see that RBA interest rate decision overnight on Tuesday. But essentially what we're looking at here is, are we going to see any sort of shift in terms of sentiment from the RBA because of the fact that we've recently seen the inflation gauge coming in lower than expected. Now, we saw the fourth quarter figure coming in at 0.6%. And you could say, well, look, if we annualize that out, 0.6% in one quarter means we're looking at 2.4% over the course of a year. That is a relatively simplified version because we're only taking essentially 3 months of data for that, and the other quarters are significantly higher. But nonetheless, it's moving in the right trajectory. And it is quickening the disinflationary pathway. In terms of market expectations, what we're looking at the moment is a pricing for 55% pricing for a rate pause in May. So that means 45% chance of a rate cut in May. And then people switch in June and they're expecting to see that first rate cut in June. Essentially a 61% chance that we see a rate cut in June. So are we going to see a repricing that pushes towards a May rate cut? In which case, if we saw that dovish outlook, that could see weakness in terms of the Australian dollar. If they push back against the idea that they're going to act anytime soon and that they talk about the need to hold off, which is quite likely, quite frankly, I don't necessarily think it's the job of the central banks to talk something up too far in advance, because number one, they don't necessarily want the markets to move too much in that direction ahead of time. And number two, they don't necessarily know what the future might bring. If we're talking about something happening in the space of 4 months, 5 months, we could, of course, see significant shifts in the market and shifts in inflation that could put them off the current course. So they're likely to be relatively cautious. And therefore, I think there's a good chance that they toe that line of holding off, remaining steadfast, and that could potentially see some strength coming into play for the Australian dollar. So in terms of the Aussie dollar, the market I wanted to look out for here is the Aussie against its neighbors, the Kiwi. So the reason for it is that we've seen this recent pullback and we're continuing to trade within this symmetrical triangle. It's dominated over the course of the past year. And therefore, the rebound that we've seen coming into the back end of this week and heading into the new week points towards the possibility of a continuation of that, this tightening of the symmetrical triangle. So if we see the RBA coming out with a relatively hawkish tone and a very patient tone, which is highly likely, we could see a near-term pop coming into play, albeit just for the short term as we look to continue this symmetrical triangle. To the downside, we would need to break down through, let me just get this horizontal tool on, down through the 106.464 level to essentially break out from this pattern. But this pattern's lasted for a year now, so I don't necessarily think we've got the justification for a breakout unless we see a particularly dovish tone coming out from the RBA, which I personally don't necessarily expect. And then finally, we wanted to look out for the Canadian picture. We've got a whole host of data coming out of Canada. The PMI numbers coming out on Monday. We've got commentary by the Bank of Canada on Tuesday, the IV PMI, which is a sort of wide-reaching PMI. So that gives us a good idea of the trajectory of the economy, which, as you can see, is relatively strong at that 55.8. The trade balance data on Wednesday, and then Friday closing out the week with the jobs data, expecting to see a potential uptick here in terms of unemployment up to 6%. That's significantly higher than most other developed economies. So question marks around that. And also average hourly wages expected to decline, but still 5.5% on the wage figure is relatively elevated. Unemployment is relatively elevated. So there's two different sides of the coin here, really, for the Bank of Canada to mull over. And then, of course, we see the impact of oil prices, and that has certainly been a key driver of sentiment for the Canadian dollar of late. In terms of the chart to watch, let me just quickly throw this up. I'm looking out for the CAD against the Japanese yen. Now, we've rallied back up into this key area of resistance. You can see that prior resistance at 110.530 being respected time and time again here. Now we're starting to roll over from here. So the question mark is, have we topped out and we're setting ourselves up for a more protracted pullback once again, or are we just pulling back over the short term before we finally break out and look for an extension of this uptrend that's been lasting since those lows in 2020? That's the big question. And in terms of the short term, we can see here that we have held on to this area of support as things stand, 108.888, and we're rallying once again. So look, you could call this as a marginally lower high, and now that we've seen a marginally lower low, then this could be a retracement before we roll over once again, and like I said, we respect this resistance and come in for a wider pullback. Or you could say, well, this has tried to break through resistance, we're consolidating here before we break higher. Each could be a potential valid opinion, but certainly I would say that this is the kind of chart that's worth watching for a potential breakout in one direction or another, whether it means setting an alert at this 108.888 for a potential breakdown and a topping pattern and give us a more protracted move lower, or to the upside setting alerts or looking for potential entries on breakouts from this resistance. Of course, the caveat is that we've seen a breakout through it previously, and it ultimately was a fake out. So you really need to try and be cautious when you're looking for these sort of long-term breakouts to ensure that you don't see exactly that. But this is a really interesting market to be following over the course of the week as we head into one that is going to be dominated by data from the Canadian economy alongside the likes of Australia and the likes of the US.